Hello, I'm Ross Mould, I'm AJ Bell's Investment Director, and I'm here with Mike Morrison, our Head of Platform Marketing, to discuss the new pension freedoms that you'll be able to enjoy from the 6th of April 2015. Now in the 6th section, we're going to look at tax and what you need to be thinking about when it comes to making the most of your pension. So Mike, I guess if people want specialist tax advice, they can go to an advisor who's a dedicated player in this area. But what are the basic issues that people should be thinking about when it comes to how they access their pension in the most tax effective manner possible?
I think the key thing for us is we all pay tax.
We do.
We don't like it. We'd like to pay less, or perhaps even more sometimes, I don't know. But, and pensions are based on tax. We're looking at income. You know, your pension fund divides into tax sections. Your tax-free lump sum is, as it says, tax-free.
That's 25%.
25%. And therefore, if you spread that out over a period of time, you're taking chunks of money that are tax-free. Alongside that, any income you take will be taxed at your marginal rate of tax. Okay. So the income you take from your pension will be added back onto any other income you've taken that year.
And then you pay 20, 40 or 45%.
Exactly. So a key thing for me would be to understand the implications of how much you're taking. Does that move you from a basic rate taxpayer to a high rate taxpayer?
Because I guess you don't want to slip into the high rate and then you get clobbered, don't you?
Just for the sake of a few pounds, right, or a bit extra tax-free lump sum. So I think the key thing for me is making sure you understand exactly what that extra amount of money will do to your overall tax situation.
So you need to understand the different ways in which you can access the cash, which we've talked about previously. You need to understand the tax thresholds and know that, again, where you sit with those. And are there any other timing issues that people need to be aware of? Does it make any difference if you take out the money in March or April?
Well, again, I mean, if you come along and take out some money from your pension in March, that will be added to the income you've taken out in that tax year. Whereas taking it the week after, it might be a new tax year and you're starting the clock
with a
rolling
clean slate.
With a clean slate. Okay. But I would also add, I think that you know, if you're looking at a 5-year plan, for instance, an investment 5-year plan, don't take out 5 years of income and put it into your bank account. Why not take out each year as you need it and use each year's individual tax allowances? 5 years of tax allowances as opposed to 1 year, you'll save an awful lot of tax. So make sure you've got a bit of a tax plan and a strategy going forwards.
And also, we're talking again about your personal pension here, your SIP, for example. We know that there are lots of AJ Bell customers who've got a dealing account with us and an individual savings account, an ISA and a SIP. I mean, is there something that people should be aware of in terms of which assets they put in which bucket, or how they decide, or how they withdraw money from those at certain times? Or what strategies could people think about there?
Yeah. There are lots of tax advantages wrappers for savings of different sorts.
The emphasis being tax advantage, they're not tax free.
Exactly. So you've got your ISA allowance, you've got your capital gains tax allowance, etc., etc. Yeah. So the key thing for me is understanding what you can and can't do with those, using the hierarchy of those allowances when you put money into
so you've got just over 11 grand capital gains tax-free anyway.
Yeah, and your pension allowance, your ISA allowance. You understand what you can put in to the best effect, and understand what you can take out to the best effect. So I think dovetailing the three together might mean you could take out your ISA income, for instance. It's paid out of taxed income, so when you take your ISA income out, it's tax-free.
So the question of which is better is probably redundant. It's more that how they can be used to complement each other.
I think which is most suitable in your particular circumstances. So for instance, if you're taking out pension income that takes you quite close to the high rate tax threshold, and you know you could perhaps just tip over it, why not supplement that with some ISA income to be the income that takes you above the high rate tax threshold, because that's tax-free and means your pension income still remains in the basic rate tax threshold.
And given capital gains tax, you get the allowance, and capital gains tax is lower than income tax. There's maybe a case to say focus on capital gains in your dealing account and income generators in the ISA and the SIP, for example.
Very much. I think that the capital gains tax allowance, which you say
11,100 in the new tax year, often forgotten altogether.
Exactly the point I was going to make. And when you start using that together with your ISA and your pension, those wrappers together, you could generate, in the right circumstances,
some quite chunky gains.
Oh, yeah, and also significant tax-free benefits before you start hitting any sort of tax thresholds at all. And the clever people will be the ones that know that, don't pay too much tax, pay the amount of tax that they want to pay. And that's the key.
Thank you very much for your time, Mike. Now, we appreciate this is all quite technical and can be a lot to take in. You can therefore find more information on our website, the address of which is shown here. You can also use the government service PensionWise. You can ask them for a face-to-face meeting, help over the phone, or log on to the website, and again, the address is clearly displayed right here. So thank you very much for your time for watching this video, and please look out for the others that are dotted around our website on the new pension freedoms.